What's up? Welcome back to How to Invest. Today we are going to be talking about the different types of stock categories, and there's a warning that if you own a stock and you don't understand the category, you might lose a ton of money on it because every category of stock acts very differently. So I am here with my sister. We're in the beginner investing series as we kind of go through a lot of the basics of investing in a more of a conversational context. And you guys can listen as I'm teaching my sister, and she can ask questions and act a little bit like the audience. I think it makes it a lot more personable, and then you also know that like this is the advice I'm literally giving to my sibling. This is what I really believe, and based off of what I've learned. So just a little background, or you want to say hi to them real quick?
Hi, I'm Abby.
Okay, cool. So a little background on me. I learned investing from Peter Lynch. He's written a ton of great books. I really like one up on Wall Street about how to invest better than the pros, better than Wall Street. And thanks to learning from him, in my career in stocks, I've averaged over 70% annualized returns. And the last couple of years have done even better than that. So let's get into this one. We've already talked about preparing to invest and building a story. If you haven't seen those, definitely watch them after this one. So you can watch this whole 7-video series. Today we're talking about stock categories. So everyone's favorite, we might as well start with everyone's favorite. What kind of stock category do you think that is? Or what do you even think I mean by stock categories?
I assume I don't know, genre. So like food or health and beauty or
Sure, yeah.
cars.
Okay, so I should say there's definitely different kinds of stock categories.
Okay.
What you're talking about is in investing terms called sectors. So those are stock sectors. So there's like stocks in technology. Honestly, technology stocks can almost be in any sector now, because now you're having like financial tech or insurance tech and that sort of thing. But the category that we're talking about today is a little bit different. This is really important as an investor, like this sort of category. We're talking about whether or not it's like a growth company or a cyclical company or a late stage company, because this affects how a stock's going to move a lot. So the warning in the title and on the thumbnail, it's not clickbait. So everyone's favorite category of stock, we'll get into the big warning one soon, is growth stocks.
Okay.
Everyone who invests wants to invest in a growth stock.
Why?
Because the company itself is growing a lot and it's exciting.
Okay. Does that mean that it's a new stock?
Yeah, so normally growth companies are newer,
Okay.
they're smaller, and they are either in a fast-growing industry.
Okay.
So like it could be, for a while, energy drinks were growing really fast. There's times like obviously the PC industry has been growing, or the chip industry can be growing, or there's sometimes even a new industry like the robotics industry with like humanoid robots. Like right now the total addressable market is really small because there's not many humanoid robots, but that industry itself could be growing 50-60% a year. So then a lot of the companies in that really fast industry might be growing a lot. But then you can also have disruptive companies in old, slow industries, like insurance. You can have a company that's growing really fast, even though the insurance industry isn't growing that fast. Mm-hmm. The company is stealing a ton of market share and growing because of that. So normally they're disruptive, they're innovative, they're doing something new. If nothing else, they know how to make their revenue go up 20 to 50% every single year. But what's important to know about growth companies, and this can be dangerous if you don't, is that growth doesn't last forever. Eventually, companies hit saturation. Whatever product they're selling, maybe there's like no one else to buy it. Everyone who might buy it has seen it already. So you reach saturation in different markets. And sometimes, and it's just important to know the story. So we talked about the story last time. So if you haven't developed your story, it's important to do that. Watch that last video. But part of developing the story is knowing, hey, this, like if it's like fast food restaurant, like maybe McDonald's early on, you'd be like, hey, McDonald's is succeeding in like 5 or 6 different states now. They can definitely succeed in all 50 states. That means they have a ton of growth ahead. You can do the same thing in insurance. There's a company called Root right now that's in like 43 states. So you know for certain that just growing the number of states is going to increase the number of policyholders or the number of potential customers. But then maybe after McDonald's saturates all of the US, it's like now they can actually put more stores in like the same cities that they're already in. So that might have more growth. Or you might know, hey, their growth has slowed. They can't grow more in the US, but they just tried a couple stores in Europe that are doing really well. Now they have all of Europe that they can grow in. So you understand the growth story. But eventually,
they'll run out of new places to have McDonald's.
Yeah, eventually, guess what? You can't have a McDonald's two McDonald's on the same corner, even if you can have one on every corner. So eventually the growth is going to run out.
Yeah.
And when a company is growing a lot, companies are willing to pay a way higher premium for it. So like in the last video, we were talking about how someone might pay 100 times earnings for a stock. Well, that's because they think it has a decade of 30, 40, 50% growth ahead. So they're really not, it's not going to really be 100 years before they've, made back their initial investment. But if a company's trading at 100 and it stops growing because you run out of space, you have a massive repricing in the market, which is really, really dangerous. So it's important to know if you own a growth company, you know how much you paid for it and how much growth they actually have ahead. Like how much more market is there for them? How many more opportunities? And there's like 5 different ways I think Peter Lynch talks about that a company can grow. One is selling more in the same market. Another is selling in additional markets. Another thing is introducing brand new products so that you literally are in new whole segments and like you're kind of starting over. Another way is you raise prices. So you can just sell the same product to the same number of people in the same places, but charge more for it. That can increase your profit.
That would be different, though, than prices changing from inflation. That's just about the cost of everything that's going up versus just changing the prices to try to make more money.
Yeah, so inflation does make companies' revenue grow.
Okay.
But if the cost of building goes up the same as they raise the price, then it doesn't make their profit go up.
Gotcha.
But so then the 5th and final way that a company grows its earnings is by cutting expenses. So like I knew Tesla was going to grow earnings because they were cutting the cost of making the car.
Because of the batteries.
Yeah, I'm confident that Lemonade is going to be way more profitable than current insurance companies because they're cutting the number of employees per dollar of premium because they're automating more stuff. So there's a lot of different ways a company can grow earnings. One way that companies try once they, have stalled out of it is they might try like buying other companies. It's like acquisitions, which can sometimes work, sometimes not. It's important to understand the story. One sign that it's not going to work is if they're buying stuff in completely different industries that they don't understand. One sign that it might work is if they're buying more companies in their same industry and they're just still taking more and more of the market share of what they're good at. Okay, so growth company, one category.
Okay. And you talked about saturation companies of it as well.
Yeah, we kind of mentioned fully saturated companies. So let's talk about that next. So these can be referred to as like a value stock or defensive stocks. Why would you want to buy one? Why do you think you would want to buy a stock that's not growing?
I guess just because they're stable, they're strong, there's not a lot of risk there if they don't continue growing. And if you got them at the value that they're worth at that time, you know that they're not going to grow a lot. There's not the worry that, this company that I bought that's supposed to be growing didn't. It's like they aren't really growing, but they're a good stock. People like their product.
That's a really good explanation. But you have to understand that you can grow your investment without the company actually growing its revenue or earnings.
Okay.
So if you pay only a 5 PE, which is 5 times earnings, so price to earnings of 5, then it only takes 5 years before that company has earned back the full price that you paid for it in profit. And what that means is that you're, in a sense, getting 20% annualized returns. Annualized, it would actually be a little less than that, or 20% would be even over.
Versus like 1 penny in your savings account.
But yeah, so it's like, so if a company you paid a 5 PE for a company and they were paying out 100% of their profit in dividends. So this is one reason why people like value stocks. Oftentimes after a company stops growing, one way they attract investors is they actually pay out their profit in dividends. So if a company you paid a 5 PE for it was paying 100% of the profit out, then literally if you put $1 into the stock, every year they're paying you 20 cents, 20 cents, 40 cents, 60 cents, 80 cents, 100 cents. Now you've made back your whole amount. So you're just making 20% a year. And if it's going to keep earning that same amount forever. It's like, it doesn't matter to me that it's not growing. It's like every 5 years I could double my position and make twice as much. And then double my position, make twice as much, double my position, make twice as much.
It's a really safe place to be. It doesn't earn a ton, but it earns a consistent amount over a long period of time.
Yeah.
That makes sense.
So for big public companies that are pretty safe and not growing at all, normally their PEs will be like between like 10 and 15, something like that. But you do see there are stocks on the market today that are trading for a 5 PE.
Okay. That are saturation stocks.
Yeah, they're not growing. Sometimes they're trading that low because people are afraid they're going to start making less money in the future. So if something is shrinking, I wouldn't recommend buying it because it's just risky. It could go out of business. But technically, if you paid 5 times earnings and something was shrinking 10% a year, it's like you can still make money on that at a certain point. Or sometimes a company has a ton of assets and it goes out of business, but they have so many assets that you actually don't lose money as a shareholder if they don't have debt as well. Because then they just sell off all their assets and they just pay it cash to shareholders. And you find out, oh, look, this company had $1 of cash per share and I got paid out the dollar because they had no debtors when they shut down. So yeah, a value stock. Okay, so let's talk about a cyclical stock. So a cyclical stock, this can be a very dangerous stock to own as well, because oftentimes people mistake cyclical stocks for growth stocks. Okay. So a cyclical industry is one that kind of goes through these cycles, these up and down cycles. And there's these big boom periods and then these massive bust periods. So one of the most known cyclical sectors is the auto market, because auto prices change a lot based off what interest rates are, because people buy cars, based off of how much the monthly payment is. Yeah. And the monthly payment can go up a ton if interest rates are a little bit higher. So in high interest rate periods, people buy a lot less cars. Automakers will start making way less sales and actually like losing money. Yeah. And then when interest rates are getting cut, they'll start selling way more and making a ton of money. So you can make money in cyclical stocks if you buy in the bottom of a down cycle and then sell nearing the top of a up cycle. But what happens is oftentimes, like Ford, for example, will just be growing its sales a ton and making all this profit and people are like, oh my gosh, Ford's a crazy growth company. And they don't understand that they own a cyclical company, not a growth company. And they just hold on to it, and interest rates get raised, or we go into a little bit of a slowdown in the economy, and Ford starts shrinking, and it gets sold off a ton, and they just didn't understand the sort of company that they own.
Gotcha. Something that's going to continue going up, and they will stay up because there is a need for that product at all times, versus one that just goes up and down because of the market and how it works. So I mean, technically in that you could keep it until it goes to another high and then sell. Yeah. But yeah, it definitely could be scary being like, wait, I thought this was going to continue growing up. If it was going up, why is it not anymore? That makes sense.
Yeah, and oftentimes cyclical companies are also mistaken for like the value, like stalwarts, or like just very consistent stocks. And they're like, why is the revenue going down so much? They don't realize that it's actually
because it's a big name brand.
Yeah,
so
exactly.
Are like, this must be a safe place to put my money. Yeah. When in reality, it's a type of stock. Okay, that makes sense.
Because like everyone knows General Motors. It's been around for a long time. Or like Ford's over 100 years old. Yeah. And people are just like, it has to be a blue chip, but they don't realize that I know when the economy turns down a bit, this gets really bad. So if you understand the type of company you own, then you know what to do with it. We'll have a section on when to buy and sell, but I'll just mention, because it was kind of in the title of this video, but if you know what category of stock you own, you can know a lot better if it's a good idea to buy or sell. Because if you own a growth company that's growing 50% a year and the stock goes up 100% and you're like, do I sell it? Well, it's like, well, not if you think it's going to keep growing 50% a year. But on the other hand, if you own a value stock and it goes up 50% in a year, it's probably time to sell it, because they did not grow in value by 50%. They're not going to be growing their revenue by 50%.
More just like the hype or something that happened in the media that kind of boosted it for a second. So if you sell at that time, it's going to go back down because it's just an even stock.
Yeah. There was one stock I owned that was like this Nokia. and it's like super beaten down. It's obviously way past its prime, but they had a new CEO coming in. I was a little bit excited he was going to be able to turn it around a bit, and that it was so undervalued. I thought maybe, it could, go up 50% or something in the next couple of years, and I could get like 25% returns on it or something over a couple of years. And it became like a bit of a meme stock, and the stock price did go up 50% in a day. And I just literally sold it.
Yeah.
Because I knew like that was the whole return I was ever going to get out of it. And there was a YouTuber I was watching who didn't sell it. And he was so mad at himself, talking about how like he wasn't sure if he should sell because it might go up more. And if he had just known like the type of company it was, and known that it's never actually going to be worth that much, at least not in the next 5-10 years, maybe eventually it could. But it's just a very stable business with not many growth prospects, not much innovation. You just know you take that one day 50% gain and you run with it.
Yeah.
So understanding that the sort of stock you own helps you make that decision a lot. Because I think to some people it's really confusing, right? Like, how come that stock's gone up so much and you don't want to sell it, and this stock goes up 30% and you're like, it's time to sell.
Yeah, that actually makes a lot more sense. I had no idea about really actually any of this before this video.
Yeah. Yeah, so if you want to go more in depth into the categories of stocks that there are, I highly recommend that you read Peter Lynch's book. Also, we're making a way more in-depth course that will literally like make you an expert in the stock market. So when that is available, it will be linked in the description as well. Do you have any final thoughts about this?
Investing can be super awesome, super rewarding, but you just have to take time to learn about it, just like anything else.
Yeah. Exactly. And I hope that if you got anything out of this video, it's that you can learn these things.
Yeah.
And you can become a good investor. There's all the information is there.
There's just a language barrier almost.
Yeah, I've been destroying Wall Street, and all I did was read a couple books from people that were really good at investing. And you can learn the stuff, and you guys can kill it. So we will see you in the next episode of Investing for Beginners. If you enjoyed this one, remember to drop a big thumbs up. The next one is going to be really important as well, because we're going to be talking about stocks to avoid. Avoiding losers is one of the best ways to have really good returns in the market. So make sure you click on the next video now. If you're not subscribed, make sure you're subscribed. I'll see ya.
Bye.